Welcome back, everybody, to Andy the Banker Show. Now, what I wanted to do here today for today's episode was to be a little bit more financially transparent with you guys. Because this whole time, I've been telling you that I have mainly a three-stock portfolio, which is 40% Microsoft, 40% in Costco, 10% in Google, and the other 10% in S&P 500. But I wanted to give you a real-life example of one of my portfolio. This is a taxable brokerage account, and this taxable brokerage account, essentially almost anybody can open it as long as you are 18 years old. I do have this account within Robinhood right now. However, I also have different brokerages such as Vanguard and Merrill Edge. For my personal experience, it doesn't really seem to matter which brokerage you use. They essentially do the same thing. But talking about that, I wanted to be a little bit more transparent on what I have invested in this particular account. What is the portfolio diversity and how am I doing? All right. So for example, as you can see, I have about 58,000 in this particular taxable brokerage account. It is the second taxable brokerage account that I opened. I started this portfolio back in 2022. So my very first one is in Bank of America. However, this one that I have, it started out in, as you can see here, May 2nd of 2022. And what's interesting about it is that at the time, if you see my principal amount, the principal amount that I put in my own money is 41,000, almost 42,000 here. However, the current portfolio of the amount of money I have in my portfolio is 58,000. So that means $16,000 is essentially money that I didn't really have to work for. This is money that my own cash reserve, my own investments have gotten me to add on to the portfolio. Now, what's amazing about this is that 16,000, this is only within essentially just 2 years of investing. All right, it's not even a 5 year. This is not even a 5 year old portfolio yet. So that's just that's amazing to see. Just seeing your assets appreciate over time, and that's one thing I really do enjoy about stocks. And stocks are just one of the very few assets that I can think of that are able to appreciate such little capital involved. Like you can start with stocks as little as $100, right? Whereas other appreciating assets that are such as real estate, you need a lot of capital for that. You can't just start with $100 into real estate. And just not every single real estate appreciates over value, right? There could be some buildings that fall down in value over time. Same thing with stocks, that not every stock do appreciate. You're gonna have some losers in your portfolio. You're gonna have some winners in your portfolio. Please keep that in mind. Now, out of the 58,000 here, here are my stocks. I did tell you I sold out of Apple. So I know I have like less than a single share of Apple. I'll probably get rid of this sometime later in the future. But let's take a look at the very first stock here, Microsoft. I have my overall investing portfolio, like across all seven, I have about, I want to say about 40%. I didn't do an actual like, day by day comparison because the portfolio percentages diversity changes almost on an every single daily basis. So if we were to take a look at Microsoft here, there's a couple things I want to keep, put your attention to, which is the current market value is out of the 58,000, 31,000 of it, 31,000 of it is in Microsoft, and my portfolio diversity here is 55%. All right, I have about 74 shares of Microsoft in this current portfolio. My average cost in this portfolio is $338. Right now, it's $430. So that's a pretty good average cost for me. And another thing is, I did tell you I have different portfolios. Right, I have about 7 in total. So this is just the individual one. Right, if I click onto traditional IRA, I also have my traditional IRA here. You can see that the average cost changes per each portfolio. On this one, I have 327. Portfolio diversity is around 40% instead of 55%. And then on my Roth IRA, I have a lower portfolio diversity at 34%. Different portfolios, give you different cost averages, different portfolio diversity. That's why it's very difficult when I have like 7 to actually determine what is my like real portfolio dice. I want to say it's around 40%. So when I look into the stock, I want to keep, put your attention into some of the very important things here, such as, for example, the market cap, right? It's trading at right now 3.2 trillion market cap. That's how much if you were to, if you wanted to buy Microsoft, that's how much you'd have to essentially pay up. You look at price to earning, the PE ratio. This essentially tells us how overpriced the company is. The higher the PE ratio, typically, not always, but typically just corresponds to a higher, more expensive of a company. So there are companies that I know of that have a PE ratio of around like under 10, right? 9 or 8. And then we have Microsoft at 36. If I remember correctly, Microsoft usually trades around the 32 PE ratio in the past. I could be wrong on that, but that's just essentially what I remember since I buy into Microsoft a ton. Of course, the PE ratio does change day to day, month to month, right? Depending on how much people buy into it. The dividend yield is 0.70%. Now, what does this mean, dividend yield? Because I in my other accounts and other videos I showed you, I do receive dividends, and I recently received a dividend from Microsoft. So if you were to have, let's say, $100 in there, right, you would get 0 about 70 cents per year. So that's essentially the dividend yield that is very, very important to keep an eye into. And also, you want to take a look into the 52-week highs and then the 52-week low. It tells you, are you buying it at the top? Are you, or is it, are you buying it at 1 year lows? So for our very next stock, I wanted to take a look into is my Costco portfolio. All right. So in this particular portfolio, I only have 23 shares of Costco. And let's take a look. So that's about 37% of my portfolio diversity. My average dollar cost that I used to have bought into Costco is around $598. What is it right now? It's around 916. Wow. So this one has given me a lot of returns. So if you look at here, since I bought it, it's gone up more than 53% total return. That is just crazy to me because right now the total market value is 21,800, and then out of that, 7,500 is just purely in returns, just the stock appreciating over time. And I want to go a little bit over into why I love Costco so much, because every time I bought into Costco, it's essentially been usually during an overpriced time period. And so if I take a look at the Costco revenue chart here, so when you take a look at Costco revenues, one of the things I really love about Costco is how predictable of a company Costco is. Right? It does not matter what economic situation we're in. 2008, they're making money. 2020, they're still making money. It's like that's a company that I just love so much. So if I pull down to on the macrotrends.com here, and if I pull into their revenues, look at 2020. Most companies during 2020 on their revenue side, they actually had lower revenues, but not Costco. It went from 152,000 in 2019 to 166. And then the next year, it got even more accelerating to $195,000. And that's a company where I'm just like, wow, like what is it going to really take to stop Costco? Because one of the things I really like about Costco is that their main business model is the revenue subscription model. They're trying to mainly make money off of the memberships, not to the actual margins itself. So it makes people excited to shop there because the customer and Costco both have the same goals in mind. And that goal is to try to buy and sell the products at as low of a margin as they can. A typical Costco item is being sold at around 11% margins, and that really excites customers like big time, big time. Whereas a different competitor, the customer and the business have different goals in mind. For example, customers trying to buy it as cheap as possible. The company is trying to sell it as expensive as possible so they can have higher margins. With Costco, again, their main thing is they're worried about is their memberships. So because of that, they're fine selling at lower margins. They're okay collecting recurring revenue. And the interesting fact about Costco memberships is like out of 100 people that sign up for a Costco membership, 93% of them, or 93 of them, are going to re-sign for another membership the following year. So that type of retention period, it's even better than like companies like Netflix. So that is just crazy to me. So on this, going back to the Robinhood page, we see the portfolio is 37%, right? However, again, different portfolios, different average cost. Like for example, if I look into my traditional IRA, it's around 46%. If I look into my Roth, 37%. So different portfolios, different cost averages. All right. When I look into Costco, you might see that Costco only has a dividend yield of 0.48%. However, Costco is one of those interesting companies where they actually like to do what's called a special dividend. And you might be wondering, like, what's a special dividend? A special dividend is it's a dividend, all right, not on their dividend yield. However, it's like a discretionary dividend, like they can pay out extra. Like for example, the dividend is 0.48%. However, if they wanted to increase that, right? No, none of the shareholders would be complaining about receiving extra money from Costco. Now, when you look at the PE ratio, though, this is where a lot of people do get worried about Costco because the Costco PE ratio is currently at a 56. If I remember correctly, when I was buying into Costco, they were usually around high 40s. Or low 40s actually, around 40, 42 PE ratio. That's what I remember when I was buying into Costco. And that's the main worrisome about people buying into Costco. And the reason why a lot of people have gone into Costco like the last year or so is because if you remember the last year or so, we've been having a lot of recession fears. And what happens during recession fears, if you saw the previous chart I showed you about 2020, 2008, Costco is one of those companies that showed that they were fine during 2008. They were okay during 2020. So as a result, a lot of investors are believing that if there's another recession, why not just go into Costco again? Now, obviously, previous performance does not, mean it's the same thing's going to happen for future performance. However, that's just a prediction that other investors are making. Now, the company that I have the most struggling returns is going to be Alphabet. All right, Alphabet, Google. All right. Yeah. Now, with this particular company, its year-to-date return, well, 1 year returns is going to be 14%. My portfolio diversity is just 7% in this portfolio with Google, with my average cost being around $121 per share, and the current price is around $157. My total return on this investment, however, has been 30%. That is not bad at all. And for again, different portfolios, different cost average. For example, my traditional one is just 3%. You look at the Roth IRA, just 0.88%. Different portfolios, different diversities here. Now, what's interesting about Alphabet here is that on September 16, which is going to be just tomorrow, actually, I'll be receiving $5.18 in dividends. Now, you might be thinking, like, what is this dividend thing? It's essentially excess profits that the company provides to shareholders. As you can see here, the dividend yield for Google is 0.13. So essentially, that just split into quarterly is $5.18. Now, what's interesting about Google is that it's at a $1.94 trillion cap, and its price to earnings is actually lower than the S&P 500. S&P 500 currently is around like 25 or 26, and Google is around 22 PE ratio. Now, one of the things I'm predicting is that Google is at least better than like 50% of the companies that's in S&P 500. And as a result, I really believe that Google's PE ratio should be going up. It's just a personal prediction I have. Now, I totally get it. People are saying that Google has a lot of uncertainty because of the lawsuits. I agree. But even with the lawsuits itself, like when you look at their financials, the business is still growing organically. The YouTube business is growing double digits. The cloud business, the most important part, has grown by 25% the last quarter. And its ad search business, the ad search business is the one that's going through the lawsuits right now, the two separate lawsuits actually. And yet the ad search is still growing by double digits. That's just crazy to me. This is a company that in the past a month or two, I've been definitely looking into buying a little bit more into, because even though I have three different stocks here and I dollar cost average into them, it depends on week to week, month to month on which one I'm going to be focusing. I don't typically spread out my dollar cost average into all three stocks. I usually pick one stock or two stocks out of the three to invest in. Then that's how I essentially manage my portfolio. Now, I hope this has helped you. I hope this has given you some insight on how I manage my money, because take a look at this, just 1 year, right? In 1 year, my assets have appreciated 12,000. That's just crazy. I mean, that's a really good way to start building your wealth. A better way than, I would say, having to go through your regular 9 to 5 job. Well, thank you so much for watching. If you had any questions, feel free to ask them in the question bar. I not only do I do YouTube, I have TikTok, and I will see you on the next episode, you guys. Thank you very much.